Do you do those different portfolios based on theme, or do you base them on sector?
That's a very good question. There's different types of models that exist out there, and we run both type. One are basically percentage at risk models, where basically the sectors are not factor neutral. And what I mean by that, as an example, there are certain portfolios we run, such as one I wanted to talk about called the American Disciplined Equity, where we're really trying to stay sector neutral with the market. We're not trying to bet that we think healthcare might do better than technology, whereas we have other models that are not sector neutral, and they really try to look towards the areas of the market that are most favorable.
Now, when you do sector neutral, there's one of two ways you can do it. You can either look at the sector weightings of the S&P 500 and say I'm going to be equally weighted to that, or if you were tracking 10 sectors, you would just make each of those 10 sectors equal. How do you run that process?
Sure. Well, our American Disciplined Equity portfolio, it's basically taking the S&P 500, and what we're trying to do is trying to find the stocks in that portfolio that have the best characteristics. As you all know, indexing is very, very popular. It's popular for the sake that a lot of money managers have a hard time beating the market over time. But when a manager goes out or an individual goes out and buys the S&P 500 index, in essence, they're buying all 500 names. Some of those names have very, very good characteristics to them, some don't, but you're buying the entire market. Our goal with the American Disciplined Equity is basically to separate the different sectors out, the 10 different sectors, and try to buy the top performing names within each industry sector, namely the top 20% in each sector. We do that in an effort to do an advanced indexing and trying to find the better quality names on a quarterly basis, as opposed to just trying to buy the entire market.
Why do you think it is that so few money managers can actually beat the market?
I think emotions has a lot to do with it. Emotions get the better of not just individual investors, but professional investors as well. What our goal with the American Disciplined Equity is trying to, again, find the top names in the different sectors, but then as the markets change every quarter, the portfolio is rebalanced to reflect the current names that have the best characteristics. One thing that we try to do with the American Disciplined Equity, because it's a sector neutral type of a product, so in other words, we're going to have the same amount of money invested in each sector as the S&P 500, but where we're going to differ is we're going to be equally weighted in each position, whereas the S&P 500 is a market cap weighted index. And what that really means is the biggest names within each of the sectors basically have the biggest weight. And as an example, GE and Microsoft and Exxon are the three biggest names in the index. They proportionally have a much, much bigger portion of the portfolio than the smallest names in the index. So it's my philosophy, instead of trying to allocate more of my clients' money, say, to a GE just because it's a 10 times bigger company, say, than Masco, I equally weight the positions within the portfolio.
Tell me, short selling. Do you have any, are there any of these subsets where you're just focused on short?
No, not at all. These portfolios that I manage right now are currently all long-only portfolios. Since we manage 13 different portfolios, one being a fixed income portfolio as well, we really try to do asset allocation based on a client's objectives to try to find the mix that matches him perfectly. So we don't do any betting on the market going down. If we feel that the market is maybe going to be a little bit weaker, we maybe do a little bit of adjustment, have a little bit more in cash, but we don't employ market timing in the process. This past quarter is a perfect example. People were throwing the baby out with bathwater. The markets here in this last month have rallied back a lot. Again, when you're doing market timing, you have to get two decisions, right? When to get out and when to get back in.
With the fixed income process, what are you doing on the fixed income side?
On our fixed income product, we use exchange traded funds or ETFs to basically have sector exposure to different areas of the market. Right now, our big fear is that inflation is starting to heat up again, not just with commodity prices, but we're already starting to see longer term interest rates go a little bit higher. So we're very short term in our process right now, and have historically over the last 2 years kept our quality very, very high, which has served us well because there's been a big deterioration in quality. Although over the last month or two, we've started to see people come out of the high quality treasuries, as an example, start to move up the risk curve a little bit, and corporates actually have done a little bit better. In fact, high yield bonds had the best month this past month in years. So I think the appetite for risk is starting to come back a little bit, but it's all about fear. So.
Great. Well, at this point, we're going to take a quick break and scoot over to our finest known facts, and we'll be back in a few minutes.
we're back. Welcome back. Before we went to break, we were interviewing Arno Mayer of the Financial Trust Asset Management, and we were talking about quantitative analysis. And I'm going to put you right on the spot. Sure. Top stocks in that you're doing right now.
Sure. I wanted to really talk about first the American Disciplined Equity, and that's again a sector neutral type model. And then next we're going to talk a little bit more about non-sector oriented models. But within the American Disciplined Equity, there's certain areas that have been doing better than others. And even though the portfolio in general is sector neutral to the S&P 500, I wanted to talk about two areas of the market that a lot of people have had a lot of luck investing in lately. One being the energy area. As you all know, oil's went over $120 a barrel this past couple weeks, and a lot of the areas that have done very well, that have ranked very high within my portfolio, have been some of the energy service companies. As an example, BJ Services and Apache ranked number 2 and number 3 over the latest period. They've had very, very good earnings growth, very high quality, but the demand for oil is really driving a lot of exploration. So I think that area of the market and those stocks in specific should continue to do very, very well in the next couple years, as there's a big drive to find new oil and replace some of the depleting stocks out there.
So in an example of BJ Services, when they came out with their most recent earnings, the stock dropped a bit because the expectations weren't quite as good. What's your viewpoint on looking at expectations versus what the actual numbers are showing themselves? And do you focus within your process on what Wall Street is saying they think the company should do?
Sure. We don't really look at earnings expectations, and a lot of times stocks in the short run will trade dramatically around what the estimated earnings expectations are and what they actually come out with earnings. We're really trying to look over the longer term trend and themes, specifically with earnings over the last 3-year periods. But we also focus on quality issues such as return on equity, return on assets, as well as valuation and momentum factors. So as an example, BJ basically is ranked high in all 3 of those categories: earnings growth, profitability and quality, and valuation and momentum. And that's what's kind of led us to that stock. However, in the short run, earnings expectations and what they come out with earnings can drive the stock in the short run. Sometimes that might be a good buying opportunity if their earnings expectations do not initially meet the projection, but I think over time the persistence of those different themes are very, very important.
Well, let's follow up on that with the quality issue. We were talking a little earlier about fixed income and about how tough the fixed income markets are. A company that has a lot of debt in the current environment can really be struggling. 2 things can happen: A, their credit lines could be pulled.
Correct.
B, they could have a tough time accessing getting more debt from the marketplace right now. What's your thought process in terms of how you look at debt within quality?
I think it's very important. Debt to equity ratios is one of the 4 factors that I use within my profitability and quality ranking. So I think that is very, very important. We also look at return on equity as return on assets to see how the whole corporate structure is utilizing its debt within its balance sheet. So I think it is very, very important. Certain industries obviously have had their credit lines pulled back in recent times, mainly because of the economic environment we're in. But it is definitely a factor that over time can make a big difference. As an example, BJ Services, out of the 36 names that are in the energy sector, ranked number 6 on our profitability and quality ranking, which again looks at return on equity, return on assets, profit margins, as well as debt to equity levels.
When you're dealing with energy companies, though, all these measures that you're using are only part of the picture. The big part that you see below the surface is probable and proven reserves, and changes in the way that accounting those reserves may be taking place in the near future. Are these the types of companies that are going to have the reserves long term to maintain those price earning ratios and to improve their debt to equity ratios?
Sure, and that's a good question, because the reserves are being depleted by a number of companies, and that's what leads to the demand for companies like Apache and BJ Services, as the big integrated oils are constantly on a search to replace their reserves that they're bringing down. We've had big oil discoveries here just recently in Brazil, as well as off the North Coast, which we're going to talk a little bit about one of the companies in another one of my models called Stat Oil that's actually done very, very well recently.